Ladies and gentlemen, good day and welcome to the Q4 and FY'25 conference call hosted by Diffusion Engineers Limited. This conference call may contain forward-looking statements based on the beliefs, opinions, and expectations as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Today on the call, we have with us the following management representatives: Mr. Prashant Garg, Chairman and Managing Director; Mr. Ramesh Kumar N, Chief Executive Officer; Mr. Abhishek Mehta, Chief Financial Officer. I now hand the conference over to Mr. Prashant Garg, Chairman and Managing Director from Diffusion Engineers Limited. Thank you, and over to you, sir.
Thank you so much. Good evening, everyone. Greetings, esteemed attendees. Welcome to the maiden earnings call for Diffusion Engineers Limited for the fourth quarter and year ended 31st March 2025. It's a pleasure to have you all here. We appreciate your presence here today. And joining with me on this call are Mr. Ramesh Kumar N, Chief Executive Officer; Mr. Abhishek Mehta, Chief Financial Officer; Ms. Chanchal Jaiswal, Company Secretary and Compliance Officer; and our Investor Relations team from Adfactors PR. Prior to this call, we've uploaded the updated presentation. I believe you've had the opportunity to go through it. Being our first conference call, let me start by giving a brief introduction about our company. Diffusion Engineers Limited has been a pioneer in the manufacturing of special welding consumables, wear plates, and wear parts and heavy engineering machinery, catering to diverse industries such as cement, steel, power, mining, and other core industrial sector. Our company is dedicated to providing products, services, and solutions that help core industrial customers to increase equipment or asset availability. Core industries are typically process plants, and plant availability is an important KPI that affects the competitiveness and profitability of our customers. Therefore, our solutions are key for the success of our customers. Additionally, we are also involved in the sale of thermal spray powders, which are manufactured in our associate company, LSN Diffusion Limited in the UK. These powders are used for wear protection, cladding, and high-temperature brazing applications for the engineering sector. Basically, this category of products are high price, high performance in nature in comparison to the products that we make here in India. In addition to this, and to complete our product offering, we are also involved in the supply of welding and cutting equipment that complements well with our welding and anti-wear products offering. We provide super conditioning services at our manufacturing facility. Super conditioning is a surface treatment concept used for machine components that enhances wear resistance, eliminates stress, and improves the repairability, ultimately extending their lifespan and reducing costs for industrial users. Over the years, we have done forward integration, developed synergies to offer comprehensive solutions to our customers. We started with manufacturing of special purpose electrodes, followed by flux core wires, which is an automated version of electrodes. Using these consumables, then we ventured into manufacturing of well-cladded wear plates, normally known as wear plates. These wear plates are an integral part of majority of industrial equipments, are integral to the performance of them. We would manufacture these liners and wear plates and supply them to erstwhile equipment manufacturers who would then assemble them on their equipment. However, as the demand for higher uptime increased, the percentage content of wear plates in these equipment started increasing significantly, which motivated us to consider venturing out in manufacturing of heavy engineering equipment. By doing this, basically, we become a one-stop shop for our customers. With strategically located manufacturing units in Nagpur, we benefit from central connectivity, which facilitates efficient logistics, reduced transit times, and cost optimization. Our robust manufacturing capabilities, supported by strong R&D and quality control, enable us to serve a diverse customer base across India and international markets. Over the years, we've expanded our global footprint and right now are exporting to more than 30 countries. Before we delve into our financial performance, I would like to take a moment to reflect on the remarkable journey that has brought us here to where we stand. Our company was incorporated in 1982 and began as a seller of special welding electrodes for superconditioning. In 1993, we ventured into manufacturing of welding electrodes, followed by the acquisition of Unit 1 in 1994 for this purpose. Over the years, we have expanded our operations strategically, acquired Unit 2 for wear plates and flux core wires, Unit 3 in 2015 for coatings that provide abrasion and corrosion resistance using polymer chemistry as a concept, and then ultimately Unit 4 in 2016 for manufacturing heavy engineering equipment. Recently, we have also commenced the production of flux core wires and wear plates at Unit 4. Additionally, our global presence is strengthened through subsidiaries in Singapore, Turkey, and Philippines, as well as in joint venture and associate companies partnerships in UK and Malaysia. And as declared in our previous quarter, our service and manufacturing plant in Abu Dhabi will go live in this quarter. We are pleased to announce that we successfully completed our IPO and we were officially listed on the Bombay Stock Exchange and National Stock Exchange on 4th October 2024. This achievement marks a significant milestone in our company's journey, reflecting our commitment to growth, transparency, and value creation for our shareholders. The listing on these but also strengthens our financial foundation, enabling us to further invest in our infrastructure, innovation, and expansion plans. This is a momentous step as we continue to build our legacy and position ourselves for sustainable long-term growth. So with this background and brief, I would like to hand it over to Mr. Abhishek Mehta, our CFO, to take us through the financial performance of the company. Thank you.
Thank you, Mr. Prashant. Now I shall take you through the consolidated financial performance of the quarter and year ended March 2025. During the quarter, our revenue increased by 38.55% YOY to 1024.48 million from 739.44 million in the previous corresponding period. This growth was mainly due to increased and timely execution of high-value orders, supported by strong demand from core sectors like cement, steel, power, etc., which also enabled successful cross-selling of our service offerings. The EBITDA, excluding other income, was rupees 147.01 million in Q4 25 as against rupees 80.53 million in Q4 24, YOY growth of 82.55%. This is on account of improved product and customer mix with continued focus on cost efficiency and operational gains. The EBITDA margin for the quarter increased by 346 basis points to 14.35%. The profit after tax grew by nearly 41.75% to 130.10 million rupees in quarter 4 of FY'25. This is mainly on account of reduction of direct expenses and impact of high interest income. Now coming to our year-end financial performance. In the year ended March 25, net revenue was rupees 3,351.96 million rupees as against 2,781.45 million rupees in FY'24. YOY growth of 20.51%, again driven by higher demand in the core sectors as well as across key product segments, and also improved market penetration in existing geographies. The EBITDA excluding other income stood at 470.76 million in FY'25 as against 388.69 million rupees in FY'24. YOY growth of 21.12%. This was due to reduction in direct expenses and also impact of interest income, and also higher gross margins. EBITDA margin at 14.04%, YOY increase of 7 bps. The profit after tax at rupees 360.40 million in FY'25 as against 308.05 million in FY'24. YOY growth of 17%. The PAT margin in FY'25 stood at 10.75%. Now, I am happy to open the floor for any questions you may have. Thank you for your attention.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Mahesh Attal from Attal Investment. Please go ahead.
Hi, sir. Congratulations on great set of numbers. This being your first call, I would like you to give us a understanding on the EBITDA margins for your three business verticals, which are heavy engineering, wear plates and wear parts, and welding consumables. If you can throw some light individually on their EBITDA margins and all.
Generally, we don't give the breakup of this because these are all product mix. The way it all depends on the product mix and all, so we don't declare the product-wise EBITDA margins.
Okay. Now, what I understand from your financials is that, sir, your RM percentage cost as part of your percentage of your sale would be somewhere around 46 point some odd %. And I fail to understand that why there has been increase in your manufacturing cost and your employee cost this year, particularly, which has grown exponentially high. So, if you can brief us on that.
So, sir, we typically look into four things before for our gross profit margin. Basically, it's RM costs, purchase of stock in trade, changes in inventory, and manufacturing expenses taken all together. So just looking at one number, you will not be able to get the overall picture in a correct way.
Why the employee costs have gone up significantly this year?
So basically, we are gearing up for our capex, and for this purpose, we have already started recruitment. So this is the reason employee cost has gone up a bit.
And what will be our numbers? Sorry. What will be our numbers once this capacity comes in line? What would be the revenue potential? What will be the asset turnover of that particular facility?
So basically, we are approximately doubling our capacity. So it will happen by end of this year, this financial year. And within next 2 to 3 years, we will be able to achieve around 80-85% capacity. So, and then our asset turnover as of today is around 3 times, and we expect it to be remain the same level as it is.
And this would be the new plant would be for the heavy engineering part or the wearable, building consumables part exactly?
So we are expanding, we are doing the investment of the capex to increase our capabilities in all three parts of the business: heavy engineering, wear parts and wear plates manufacturing, as well as consumable manufacturing, as we are seeing growth in all three parts of the business.
So what would be the capex outlay for the next year, sir? FY'26?
Total of 100 crores is what we are doing.
Okay. All right. Thank you so much.
Thank you. A reminder to all participants, if you wish to ask a question, please press star and one on a touchtone telephone. Our next question comes from the line of Ankur Gulati from Genuity Capital. Please go ahead. Mr. Ankur, your line has been unmuted. Please go ahead with your question, please.
What is the current capacity utilization?
On an average of roughly around 85%.
At present, right? on this
Yes.
335?
Yes.
So unless the new capacity comes up, I guess the growth will be pretty stagnant, or at least for next 3 quarters. Is that fair?
It's not such a linear sort of assumption because it also depends on the product mix. Of course, we don't expect it to be flattish. We expect the growth to continue. But of course, with the addition of the additional capacity, the growth will be much more significant. Because some of the orders that we have, have longer lead times, some orders are having shorter lead times. So that's why it depends on the product mix.
And Prashant, your percentage from rear plates has increased. And I'm guessing the margin is increasing because of that. Is that a fair assumption, that as percentage of rear plates increase, your margins will keep improving?
So the margin increase has happened because of the volume growth. So as the economies of scale kick in, our purchasing power increases, and therefore we are able to sort of, get better margins. Also, we are dealing in the business where the key raw materials are metals and alloys, and these are very much dependent on a lot of macroeconomic events. So previous year specifically, the prices of metals and raw materials were quite low. So that also helped in the margin increase.
And just to confirm, you said the asset turn on new plant is 3 times, right?
Yes. Our historical asset turns has been around 3 to 3.25 times, and we expect the same asset turn.
And Prashant, just one more thing. If you can help us, of the total revenue, how much is directly from, let's say, the end client, and how much is still coming through the OEMs who are in turn dealing with the end clients?
Just a minute, I'll just confirm to you. So, yeah, around 78%. Roughly around 23% is through 23 to 25% is through OEs.
OEs or the end client?
The rest is the end client. This is 23% is from OEs. Out of the rest, there is some small portion of channel partners also.
Understood. And what was this percentage of direct, let's say, in financial year 24?
That nature of the business has not changed much. We don't have the percentage sort of ready with us, but the nature of the business in terms of sales through channel partners and direct end customers has not changed much.
That's okay. And what is the export percentage in financial year 25?
Approximately 12 to 13% is overall international sales.
And again, if you can help with the same percentage last year, please.
It was 13 to 14%.
So same cheese. Okay. And there is some share of loss of associate. What is that? Some 2 crore.
So we have an investment in the in a UK-based entity where we own 21.5% of that entity. It is involved in the manufacturing of nickel and cobalt and iron-based powders. So that's they've made a loss in the preceding year, which is been added in the consolidation of our financials. Our share of that loss is what is shown there.
Got it. And last thing, any thoughts on bringing working capital down? I mean, we're still hovering around 95, 90 odd days.
Working capital would remain in the same level because we are also into heavy equipment and other things, and the payment cycle is around 90 to 100 days. So working capital would remain in that period only. And also because the manufacturing time for heavy equipment is around 6 to 9 months, which increases my inventory period also.
Okay. And just one more thing. Post-IPO, usually, when you had quite a bit of capital in hand, which is also visible to some extent that your payable days have come down. So is there any benefit in the EBITDA margin sitting because you guys were able to procure material on cash basis and that's why get it cheaper?
We have not used our, I would say, IPO proceeds for any payments of our vendors or creditors because the objects wanted reduction of working capital, which we did. So there was some benefit of interest because this year interest cost had been very high as compared to last year. So there was some impact of interest which we got in the finance due to IPO.
All right, got it. Thanks. I'll fall back in.
Minor impact.
Yep, thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question comes from the line of Shaurya Punyani with Arja Partners. Please go ahead.
Hi, am I audible?
Yes.
Yes, sir.
Sir, a few questions. So what is our current capacity in number?
So we have 4 manufacturing plants and 3 aspects to our business. So welding and anti-wear consumables, wear plates and wear parts, and heavy engineering. So we don't have a single capacity figure per se. There is capacity mentioned for all these different product lines, and it was mentioned in our DRHP. So you can have a look at that for all different divisions.
Okay, sure. And this new plant which we are adding, which will double, that is a Nagpur plant which is made in CPT, right?
Yes, that's right.
So that is by November, you are saying it will come up?
So it is already, the project is already underway, and yes, our intention is to finish and start it in this financial year.
So what is the overall expense for this plant, right? Which has been spent and which will be spent also combined?
So we are setting up 2 plants. One is heavy engineering unit or at a location called as NIMG, and there we are spending close to 70 CR. And another location is at B33 MIDC. There we are approximately spending 30 CR.
Total 100 crores, okay.
Yes.
And we are expecting an asset turn of 300 crores from this, right?
That's right, yes.
And so any view on what should we expect the revenue for the next 1-2 years in terms of growth?
Generally, we don't give forward-looking numbers, but definitely our aim is to grow more than the market.
Okay, more than the market. And margins will also improve, right? You are saying?
Yes.
Yes, we will try to improve our margins.
Okay. Thank you, sir. Thank you.
Thank you. Our next question comes from the line of Rohan Mehta, who's an investor. Please go ahead.
Good evening, sir. Congratulations on a good set of numbers. Sir, if you could just help with a breakdown of our top line in terms of the product categories that we have or any key segments, that would be helpful, sir.
It's almost all our major items like heavy engineering, welding consumables, wear plates and wear parts contributes equally to the top line.
Okay. So we don't look at any product baskets or any segments per se?
So 3 product baskets are heavy engineering, welding and anti-wear consumables, and wear plates and wear parts. And each of them sort of are almost equal in terms of the revenue contribution.
I see, sir. And do these also fetch around the same level of EBITDA margins?
No. Different divisions have got different EBITDA margins. On qualitative terms, anti-wear and welding consumables offer higher margins in comparison to wear plates and wear parts and heavy engineering.
I see. Okay, sir. So this ratio of revenue, if we were to say 1/3 each, would you see it to remain the same in the coming fiscal year, or do we have any sort of plan to change this share of revenue, maybe increase the share of the higher margin parts, or how do you see that, sir?
Yeah. So see, what is happening in the industry is the customers are moving away from buying consumables themselves and doing the repair and welding activities themselves. They are looking to work with suppliers who can provide them ready-to-fit solutions and complete solutions. And we are aligned with that change that is happening in the industry. So we see that, the heavy engineering and the wear parts business to grow faster than the consumable business. The consumable business will grow by eating market share from our competitors, but there's more organic growth available in heavy engineering and wear parts business.
Okay. Understood, sir. Do you also look at revenue from maintenance separately and those from capital projects separately? Is there a proportion over there also?
No, we don't track it separately because the end customer remains the same for us. Whenever he's setting up a new facility or a new plant, he reaches out to us, and for his existing operational expenditure for the upkeep of the plant, we are again in touch with them. So we don't really, sort of monitor that separately, but ballpark number is that typically all the OE business, 80% of the OE business is all new project build, and the rest is for the operational maintenance of the existing installed base.
Okay. So maintenance can serve in a way as a recurring revenue to certain extent.
100%. Yes. So even when the capital markets cycle is down, we keep getting business from maintenance because the focus of the customer is to keep running their equipment or the plant at highest possible capacity without spending more on new project build.
Okay, sir. And just, sir, for my understanding, what is the typical life cycle of the product? I mean, in terms of when it would need to be replaced.
So typically for wear plates and wear parts, the cycle could be anywhere between 18 months to 24 months. And of course, from industry to industry, location to location, depending on the wear and tear, it can increase or decrease. But a good average can be 18 to 24 months.
Okay, understood, sir. So any capex plans in the foreseeable future?
Yeah, we have just
raised 100 crores investment.
Okay.
This year itself. We will be doing it. For that purpose only we have raised the funds from the market.
Right, sir. And this our capacity would increase by how much, sir, by the end of this?
It would approximately get doubled.
Okay. And sir, right now our utilization levels are at what percentage?
Around 80-85%.
I see. Okay, sir. Just one last question, sir. You mentioned that exports have been in the range of 12 to 14% historically. Is that also likely to remain at that level in FY'26 and onwards, or do you wish to export more or anything like that, sir? Some color on that.
So you need to see that our revenue has been increasing steadily over the last 5 years, and therefore it seems like export as a percentage has remained same, but actually in absolute terms exports are increasing, and definitely our focus is to increase exports. But of course there's growth happening in India, so it gets offsetted in percentage terms.
And we are not only looking at exports. Our exports, what we are talking about right now, includes international sales also, that is 12 to 13%.
Right, sir. So do we make a higher margin in our exports?
Generally, margins are a bit higher in the exports because of the other things associated with it.
Right.
As compared to.
So there's more competition in India in comparison to the geographies where we're exporting, so margin realizations are better there.
Right, sir. So just speaking of competition, if I may ask one last question, I wanted to get your views on the competitive scenario and our sort of right to win key strengths per se. What differentiates us, and how do you see the competitive environment in India?
So because we have done a lot of investments in our own facilities and we have internalized our capabilities, we have an integrated supply chain for our customers, and that helps us to deliver faster and also do a lot of cost control So we are competitive because of that's the main sort of advantage that we have in comparison to our competitors.
Okay. So do we also do R&D in-house?
Yes, we have our R&D labs are DSIR certified. They are approved by Department of Scientific and Industrial Research. We've got the certification for the second time now.
Okay.
And R&D is key to improving our product offerings to our customers because the production demands of our end user industry is constantly increasing. You see the average plant sizes have gone up, and therefore any breakdown that happens in our customer plants causes greater loss for them. And therefore there is more higher performance expected from our products, and R&D is key for that.
Right, sir. That's great. So do we have any budget for R&D as a % of sales?
We spend close to around 1% of our revenue as of now in R&D.
All right. Okay, sir. Okay. Thanks a lot. Thank you for answering my questions, and all the best, sir. Thank you.
Thank you.
Thank you. Our next question comes from the line of Avdut Joshi from Bryanston Investments. Please go ahead.
Hi, good evening. Am I audible?
Yes, sir. Please go ahead.
Yeah. This is about the UK-based associate company. So you, as you mentioned, it manufactures powder. So how you are looking at integrating it with our business? What are the plans going further in that business? And at what level do you see becoming profitable? These are my questions.
So we are the exclusive channel, apart from being the shareholders in that company, we are the exclusive channel partners for selling the products manufactured in that company in Southeast Asia. So that's a direct way of our involvement in that business. So all the products which are getting sold in India, Vietnam, Indonesia, Philippines, we are responsible for that sales. As regards to profitability of that company, so it is based in UK and it works with metals which are very volatile in terms of the costing or pricing of these metals. So they are basically 80% of their produced is nickel, and nickel is traded on daily basis. And because of the Russia-Ukraine war which happened in 2022, there was a significant increase in nickel cost. And last year there was a reduction there was a significant loss in that entity because in 2023 there was a significant correction in the nickel cost. So the stock value of the nickel or the raw material that they had got corrected. So there was no cash loss, but there was correction in the stock value, because of which there was loss. Going forward, we don't expect similar such losses in that entity.
But initially, when we invested in this company, what was our intention? Were we looking for any technology transfer kind of thing and getting into that business sort of thing?
So we are one of the founding shareholders of that company, and the intention was to, and as I mentioned in my earlier introduction, the products which are manufactured there are high price, high performance products. So it was sort of a good complementary addition to the products that we are supplying in India. So the intention was to get involved in a manufacturing unit right from day one, rather than just buying and selling it in the industry.
Understood. So eventually, in current situation also, we have fair enough idea about the manufacturing process and the procurement all part of. Is that the correct understanding?
Yes. Sure.
Sure. And the second part, pardon my ignorance or the lack of knowledge, but if you look at the margin profile of our company and let's say AI engineering, which is into grinding media and mill liners, if you compare the margins, our margins look a bit lower or much lower as compared to that. So is this because of the blended business, heavy engineering plus the other piece which is welding, which is driving down the margins in a way?
Yes, that's a good assumption.
Okay. And so in other assumption stands then, the wear parts will make a similar kind of margins?
So, see, any place where there is entry barrier, an entry barrier can be in form of a more sophisticated or a more difficult to manufacture part, or
Margins
there is
will be higher. I
margins
understand.
will be higher. So we can't just generalize that where parts will have similar margins as that of AIA. But yeah, there are certain parts which are sort of more proprietary to us, where we excel, there we make better margin. In the other more usual parts, the margins are a little bit lower.
Understood. Thank you.
Of course, the initiative is to do more and more where we are earning more margins.
Understood. That I can. Thank you. That's it from myself, and all the best. Thank you.
Thank you.
Thank you.
Thank you. Our next question comes from the line of Lakshmi Narayanan Ganapati with Tunga Investments. Please go ahead.
Thank you. Quick question. I look at the welding and anti-wear consumables.
So before you go ahead, sorry to interrupt you, sir. So your audio is slightly muffled. May I request you to use your handset, please?
Is it better now?
Slightly better, sir.
If I look at the businesses, the wear plate, the consumable business which you have, that has not been growing at least in the last 2-3 years, at least from 24, 23, and 22. What has been the growth in that business this year?
No, it's not that it's not been growing in 22, 23, 24.
It has been growing, I think, relatively. I think it's a slower growth. I just want to understand this year's growth. Where has been the contribution from? Is it from the welding and anti-wear consumables, or is it from the which business contributed to the maximum growth this year?
So there is a mix of from all the three divisions, and specifically we don't divulge what is the gross margins in each of the divisions.
You think growth.
No, I'm asking for growth, sir.
So that's what I'm saying, the growth. So basically,
more growth there's growth happening in all the three parts of the business, but of course, more growth has happened in wear plates and heavy engineering in comparison to the welding and anti-wear consumables.
So if I just look at the wear plates business and the heavy engineering business, what is how many clients you have in the heavy engineering equipment business, and how many clients you cater to in the wear plate and wear parts business?
So,
and how many are common?
So these are again qualitative analysis I can give you, because I don't have numbers offhand ready. But so the basic idea of the business is to do more and more for the same customer. So we started with supplying welding electrodes, flux core wires, and we got into wear plates, and then wear parts, and then heavy engineering. So we are doing all the three product divisions that we have. We're supplying to the same customer. So there is a lot of commonality. I would say all the heavy engineering equipment customers are also our consumable and wear part customers. And to tell you the number of customers that we have in heavy engineering would be close to around 50 odd customers, and wear plates and wear parts would be in excess of, I think, close to 1,000 customers. And this is just again numbers at the back of my head.
Got it. The wear plate and wear parts business. Yeah, that answers. And the wear plate and wear parts business, do you actually do the business on site, or do you actually do the business in your place and then you go and assemble it there? What is the kind of business you do on?
No, so majority of the business, wear plates and wear parts, is done in our workshop. And of course, there is sometimes a request from the customer where they would ask us to do some assemblies on site, but that's not a big part of the business.
And among the sectors, which sectors actually grow the business? Is it cement or steel, or which sectors spearheaded the growth for this year?
So majority for the biggest sector that contributes to our sale is cement, followed by steel, power and engineering. And we're seeing growth in all the sectors right now. because there's a lot of capacity expansion and increase of utilization in all these sectors in the country right now.
Because see, this heavy engineering as a thing is very vast, and I mean, there are companies like L&T does it. There are companies like KCT also does this heavy engineering. Now, what is your edge and what do you differentiate? What is the specific sliver where you have unmatched customer loyalty and the product quality is the best? Can you just throw a little light on, because heavy engineering is a very vast thing.
So our
specific sliver
because we are first a welding alloy design company or a welding consumable design company, we understand metallurgy very well. We understand materials very well. So in comparison to a generic or like a plain heavy engineering company, we've become this after we were first, welding consumable suppliers or wear part manufacturers. So I think that is our strength. Our strength is our composition, our chemistry that we develop through our welding consumables, which enable us to give complete solutions to the customer. Using our weld alloy design capabilities, our equipment that we manufacture can last longer, which is a very important equipment, that will enable the customer to have higher equipment availability. And this is very important for any process plant, because equipment downtime means profit loss for them.
Got it. Okay. And when you say equipment, how many SKUs you manufacture, or how many units of heavy engineering equipment you actually make every year?
These are made to order parts. It varies in size. It can be as small as a 10-ton equipment to 500-ton equipment. So these are all tailor-made, made-to-order items. These are not standard off-the-shelf items that we sell to the customer. So to give you the
broadly, how many? Yeah.
I don't think so.
No, so it is not to be measured that way, because as I
mentioned, just to get a sense of, I understand. I understand you make these tandem weight and tipplers, you make hammer crusher assembly and so on, various things, right? So I just want to understand, whether it runs in hundreds or runs in 200, just to get a sense of proportion.
So to put it simple, it runs in hundreds, but we don't measure it in that way.
We measure it more in tons than the number.
We measure in terms of tonnages. Okay. And from a working capital point of view, is heavy engineering equipment, what is the kind of turnaround time or the inventory days or the working capital is there in the heavy engineering equipment?
For heavy engineering, generally the turnaround time from PO to payment is PO to delivery is around 3 months to 9 months, and additional 90 to 100 days for payment.
Thank you. Mr. Lakshmi Narayanan, may we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn, sir. Thank you. Our next question comes from the line of Mahesh Attal from Attal Investment. Please go ahead.
Sir, just on this part of, capital that we have raised. So what I understand is that has been placed with mutual funds. So these are like equity funds, or you are placed it with,
No, we have not placed any capex money with mutual funds, because SEBI LODR also does not allow that. The entire amount is invested in fixed deposits with the scheduled commercial bank.
And
the mutual fund investment which you are seeing is from our own free cash flow which we have done.
So it is on the equity side, or it is on the
mostly on the equity side. Mostly on the equity side.
So are you taking a professional help, or is this just internally we are doing it?
No, we are taking a professional help.
All right. And secondly, my question would be, you have in your media release you have given this someone giving you an order of flux core wires. So if I may ask, how big this could be, the order value?
So Right now we have just received a small amount of orders, but we are expecting it to be going good once we start working on that sector.
And if I may ask you, what is the run rate for our cold repair compounds business?
When you say run rate, you mean to say how much revenue we do out of it?
Yeah.
It's roughly around 3% of our turnover, total turnover.
And what about cold flux?
2 to 3% of our total turnover. Sorry, I didn't get the second part of the question. Flux core wire is roughly around 10%. It's roughly around 7%.
And special electrodes?
In such detail, we don't give to the market actually.
All right. Thank you.
Thank you. Our next question comes from the line of Devesh Tated with Fintrust Capital. Please go ahead.
Yeah, hello. Am I audible, sir?
Yes, sir. Please go ahead.
Yeah, sir. I wanted to know about that. You earlier said that we'll grow by more than the market. So if I may say that market grows by 12 to 13% CAGR, we are almost doubling our capacities. So if you just could give the capacity utilization for the next year, broad guidance, any ballpark number, so that would be good for us.
See, basically, our new capacity will come up by this end of year, and our new capacity will start getting utilized. We can't with the exact ballpark numbers, but our numbers would be better than what it is today.
If you could just tell us.
It will take about 2 to 3 years to reach the new capacity also at the same level of present capacity utilization.
Okay, sir. My second question would be around the products. Earlier you said that we are using synergies of welding and heavy engineering. So I just wanted to know, are there any scope of adding new products in this heavy engineering equipment, because it is a very vast segment. So are we exhausted, or we can add more products in this product portfolio?
No, we are not at all exhausted. I think we are just starting here. With the capex that we are going to do in this year, we are adding to our machining capability, and that will enable us to make larger and more precise parts, which in India there are very few suppliers who can do this. Secondly, we are also getting into newer sectors. So typically we've been strong in engineering, steel, cement, power, but we are looking at newer sectors where the margin realization will be better and will require more sophisticated manufacturing capabilities. So there's a lot of scope of improvement and increase in the heavy engineering sector.
Okay. And my last question would be on the orders front. So I can see your order book is around 120 crores, I guess, 100 crores. So are these orders on a recurring basis, or this is the final order book?
No. As we speak, the order book keeps increasing. These are same. A lot of our customers are existing customers, and they keep ordering to us on regular basis, on daily basis.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Our next question comes from the line of Ishpreet Kaur from Relax Capital. Please go ahead.
Hi. In the heavy engineering space, how much is the in-house use of materials that we make, say, from the welding parts and plates and the welding consumables? And you do machining also in-house, or maybe adding the capability. So how much of it would be made in-house?
So it's approximately, so it again depends on order to order, but on average I can say roughly around 20 to 30%. Average we can say it can go up to as high as 50% and go as low as say 15%. So the ballpark range will be 15 to 50%.
Okay.
This is without machining. This is just pure usage of our own consumables and wear plates and wear parts.
Own products and machining would add to it.
Yes, machining and sometimes even services would get added.
Okay. And typically, these all the equipments are outright sales, or is it also rental?
So majority of it is outright sales. Rental model is something that we have just recently started, wherein there's a specific kind of a wear part where we are specializing in, which we are offering to the customer on rental basis. And the monthly rental that we charge to the customer, it includes the cost of supply as well as maintenance. This is new part of the business. It's still sort of, as it is new, the turnover contribution is still quite small in comparison to the heavy engineering business.
Okay. And would there be any capital commitment towards this rental part of the business? How much would that be?
There is no per se capital commitment to the rental part of the business.
In fact, the current 2 contracts which are ongoing have already been paid for completely.
Yes.
So there is no capital commitment in the books right now for this.
Okay. In just one clarification, like you said, margins can improve from here, but you also mentioned that welding consumables have higher margin and the growth in the heavy engineering and wear parts should be higher. So the margin improvement is likely to come from where?
So as I mentioned, with the addition of our capabilities in heavy engineering and wear parts, and also with export sales increasing, although percentage of welding and anti-wear consumables as a total business may come down, but even that is growing. And on top of that, with export sales and manufacturing more sophisticated wear parts and heavy engineering equipment, we are expecting margin to grow going forward. In addition to this, we are also, we didn't talk about this earlier, but we are also in industrial services where we are providing a critical breakdown and repair services for the customers on site, and also are into kiln alignment and kiln services, which are adding to our margin, which is adding to the contribution of the company.
So this would be the service revenue.
Yes, it would have mix of both.
And how much would that be as of now?
Just 1 second.
It would be around 1 to 2% of our current numbers.
And if there are higher sales of heavy engineering products, do you foresee that this could also be a substantial part of the revenue going forward?
Foresee what to be substantial part of the revenue, sorry?
The service part of the business. Service revenue.
No, so service revenue doesn't depend on heavy engineering business. The service revenue, the services that we are providing is for the current already installed base in the industry. It is got, tomorrow if the heavy engineering business becomes zero, it will not affect the service business.
Okay, so it's linked to the consumables and the wear parts. And
yes, and also, yes.
Okay, and do you foresee this to become a little larger part of the revenue going forward?
Yes, 100%. We have started critical services wherein, which are very important for the running of the plants of our customer. And this is also a very good sort of door opener with our customers, where when we enter with such service offerings to our customers, it helps us get related business or business for other divisions in the company.
Okay, sure. Thank you so much.
Thank you.
Thank you. Our next question comes from the line of Sagar Shah, who's an investor. Please go ahead.
Hi.
Mr. Sagar Shah, your line has been unmuted. Please go ahead with your question.
Hello, am I audible?
Yes, sir.
Yeah. So just one question on the return number. So you mentioned in the PPT that your return on capital employed is 15%, and going down the line 3 years from here onwards. So what do you expect your aspirational return on capital employed number will be?
We will be either the pre-IPO numbers or we will better the pre-IPO numbers.
Oh, okay. Great. And one question on this order book per se. So you mentioned that you have an order book of around 103 crores. So can you bifurcate between how much this order book is from the new customers or from the repeated customers, like 50-60% from the repeated only, or other from the new customers?
Yeah, it's much more excess than the 50% is the repeated customers.
Okay. And one question on this in specialized energy solutions. So could you give the revenue contribution from this part of your business?
So again, as said, we have not disclosed the revenue part on the separately.
Okay.
For
So
the
down
revenue
the line, next 2 years, would you expect the revenue contribution from this segment will increase significantly?
Which segment is it?
High energy solution, like you are focusing on this segment.
It's heavy engineering
Specialized energy solution.
Energy solutions, as we are not able to get it, because are you talking about welding consumables?
No, sir.
We are not able to understand your question. Sorry. So which segment are you referring to, sir?
So Mr. Shah has dropped from the queue. I'll move to the next question. It comes from Mr. Ankur Gulati from Genuity Capital. Please go ahead. Mr. Ankur Gulati, your line has been unmuted. Please go ahead with your question.
Just directionally, I mean, some of your businesses are higher margin. So do you think, at least in the new unit, you will allocate more capacity or area to higher margin, or how do you see the overall space allocation?
So basically, we are expecting that all the 3 divisions which we are having will grow in equal proportion. So doing a separate allocation in a separate thing is not what we are discussing. We are exceeding our capacity for welding consumables also, for heavy engineering also, and also for their parts.
And the product mix is there, so it all depends. It is not necessarily that exactly we can allocate the space and keep changing the place depending on the number of products, except for the consumables which we have a machine which we manufacture.
Got it. And going back to the rental business, just from a balance sheet perspective, will that, if that vertical grows, will that do you guys have to keep more inventory on the books?
No, so we have already explored tie-ups with NBFCs where they are ready to take these assets on their balance sheets, lease it to us, and then we can sublease it to the customer. And so it will not have any balance sheet effect for us. Suppose tomorrow if we get 10 such or 20 such contracts also.
And Prashant, have you guys done any sale on this, or is this still in exploratory stage?
No, we are already getting some sales from this initiative.
And are you guys in a position to discuss economics of this model as yet, or is it too early?
Sorry, Mr. Ankur, your voice is not...
Are you guys can you guys give more details on how the economics of this model will work, or is it too early for you to share details?
We can't give these details over here.
Because we have just started and there are 2 projects which are running. So
that's
at
fine.
This stage we will not be able.
That's just a bookkeeping question. There is another income of 5 crores in second half. Is this largely interest on IPO proceeds?
It's not in IPO. It's largely due to interest on IPO proceeds.
And so then the follow-up is, if I knock it off, then at least the revenue hasn't grown. Any specific reason? Oh, sorry, profitability has not grown. So any specific reason?
Even if you see our EBITDA has grown as compared to last year,
Without other income.
Without other income also, you see my EBITDA has grown significantly.
Just one second, sir. On a year-on-year.
So our EBITDA margins have grown to 470 million in FY'25 as against 388 million FY'24 without other income.
That is 21% growth.
All right, I can take it offline. That's clear. Thanks. Yeah. Thank you.
Thank you. Our next question comes from the line of Sana, who is an investor. Please go ahead.
Congratulations and thank you for the opportunity, sir. Sir, I would like to understand what initiatives the company taking on the sustainability front and like energy efficiency or waste reduction, and how these efforts will support our revenue and profitability outlook.
With respect to environment, we started monitoring all the energy consumption as well as the fuel consumption, and we started putting our trees to substantiate this. And we also have the solar energy generation, but it is not equivalent to that energy, but going forward we will be working on it.
Also, in our IPO, one of our objects in our IPO was solar generation, rooftop solar, so that we will be doing it.
Okay, sir.
So just to add to that, we are planning to set up a 1.1 megawatt captive rooftop solar plant in our heavy engineering 1mg unit. And, in the other plant also we are planning to add that. So that was one of the objects of our IPO.
Okay. Thank you so much, sir. That was all from my side.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Prashant Garg, Chairman and Managing Director from Diffusion Engineers Limited, for closing comments.
I would like to thank all of you for taking your time out and attending this call. I am thankful to each member of our company, Diffusion Engineers, as well as our clients, creditors, banks, financial institutions, and all other stakeholders. For any other further queries or information, please get in touch with our investor relations team. Thank you so much.
Thank you. On behalf of Diffusion Engineers, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.